Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, November 10th, 2021. And our top story today, how widespread are price increases and what are the risks for continued inflation? Joining me now to discuss this and a lot more is Francisco Martin. He's an economist and assistant vice president with the Federal Reserve Bank of St. Louis. Francisco, it's great to see you. Thanks so much for joining us on the program this morning.
Thank you. It's great to be here.
We're going to talk a little bit about inflation, not probably an economist's favorite topic to talk about because there's so much data in there, probably not so much for consumers. Let's start off with price increases. And I know I'm particularly going to focus on a couple of your blog posts. How widespread? I mean, we're seeing it, if I'm a consumer, gas prices, certain things that I buy every week, every day. But how widespread are these price increases, sir?
So they're quite widespread, and they're getting more widespread as time goes on. Part of the problem is that when the pandemic hit, a lot of prices actually went down, like energy, because of, a collapse in demand that brought prices down, and then they started coming up, and now they're higher than pre-pandemic. So you have to be mindful of that, right? That it's not just the recent increases, but relative to where we were before this hits, and there's a lot of movements. We all heard about lumber prices. They went up, but then they came down. So I think the way to look at things now that kind of most of the kind of ups and downs happened is to compare where we are now relative to where we were pre-pandemic. And there what you see is that, yes, there are some prices that have grown kind of in a very significant way, right? So if you look at used cars, for example, they've grown quite a lot. But if you go outside those kind of headline grabbing numbers, what you see is that, food has gone up. As I mentioned before, energy has moved up. But things like services have increased as well. Maybe perhaps not as much as these headline grabbing numbers, but for sure the rate at which they're increasing over time has accelerated some, and that's basically explaining why we see an increase in inflation.
Well, thanks for that breakdown, Fernando. When you look at, I think you kind of hit on this with certain goods and services, and you mentioned the supply chain, and let's unpack that a little bit. We hear from the popular press there are a gazillion ships out on the Pacific that cannot bring in goods and services, goods that we need here in the country, and therefore we have a shortage. Is that the only reason why you get price increases, you get inflation, because you can't have delivery? Or are there other things that can lead to inflation?
Right. So the answer is no, there's other things. But let's start with the supply chain. I like to point out that every time you read an article on, those ships blocking the view in the coast, the article invariably starts, showing you how many ships there are, how long it takes for the materials to get unloaded, et cetera, et cetera. And then somewhere in the article, they mention, by the way, we're having record shipments, and people are buying all this stuff. So what does that tell you? That everything we did for COVID kind of contributes to making this more difficult, right? There's, perhaps less people working in the relevant services to, import those goods. And there are some mitigation strategies that make that, kind of more prolonged. But on the other hand, we're buying a lot of stuff. And, there's one simple example. When the pandemic hit, what happened? Everyone, a lot of people went on lockdown. They started working from home. People realized, I don't have a webcam at home. So we all went and bought webcams. It turns out there were only so many. They ran out, so you started to wait. And, that took a while, but you can imagine how something like that can happen to many other goods when we all kind of start buying the same things. Now, that's kind of driven by the pandemic, but a lot of the demand right now is also being driven by the fact that we've been sending checks to people, right? So when you look at one of the features of the pandemic was that personal income went up. Why? Because the government kind of took this approach of, We're not going to start, saying you need money or this other person needs money, because it's very confusing. We don't know who's working at home, who really needs, who's getting fired, who's not. I mean, it was very complicated. So they decided just to say blanket. If you make less than this much money, you just get a check. So I didn't get one. People did get, my girlfriend got checks because she's a teacher. So what happens? Well, if you somehow you stop going out, you didn't have as many dinners, etc. You started saving, and if you started saving, at some point you realize, well, it's nice, perhaps now a nice time to buy a new TV or to upgrade your furniture or to improve your home office, etc., etc. So that has led to kind of a surge in demand, especially for durables, and that's one of the things that struck me the most, which is you look at the data, you see these price increases, but then you see the quantities being bought and they go up, they don't go down. So it's not like, oh, things are getting more expensive and we cut down on those. No, we're buying more of those things, which tells you that part of the story, and perhaps a fundamental part of this story, is that the demand for certain goods has surged. Okay, and that, of course, production takes a while to catch up. So the way producers deal with that surge in demand is to increase prices. And a lot of what you see in durable goods is driven by just a surge in demand. I mean, I will point at the example of chips. I mean, it's true that, so there's so like automakers, they have a timing issue. They delayed kind of producing new cars, so they didn't buy the chips on time, and now they're scrambling to get them. But a lot of the other stuff is being driven by pure demand. Okay, so everyone is upgrading their computers. People are mining for Bitcoin, so they're buying chips. Zoom needs, like the medium we're using now, they need to create all these servers so that we can host all these meetings. So they also needed chips. So part of it is, like I said, is the government sending money to people. The other thing is the transformation of the way we work made us have, change also the way we live, right? So now you have a home office on top of perhaps your business office. So you need to buy the stuff so that you can do it effectively.
Yeah, and it seems like, we've had a paradigm shift, as you mentioned, people working from home. And with that paradigm shift, as you seem to be indicating, I don't want to put words in your mouth, that because things have changed, how people buy, what they buy, is indicative of those changes. And so I guess my last question for this segment is inflation a normal part of the economic process? We hear about it all the time when, the Fed governors meet, and we hear about, is there going to be a rate increase? Is there not going to be a rate increase? But it would seem to me that inflation is a part of the economic system. I'm not an economist. You are, so correct me if I'm wrong.
Well, I would say it's not inevitable. So part of the suddenness of the shock, again, as I mentioned at the beginning, initially prices actually went down. Not for every good, just on average, right? So you look at the price level, it was growing at something close to 2%. The pandemic hit, it dropped. Okay, and then it started growing, and then it grew faster than it used to. That's what we call inflation, right? The rate of growth of the price level. So it's not inevitable that it had to happen in that particular way. I mean, a lot of it is driven by the idiosyncrasies of this particular pandemic, the way it hit, the way we managed it, and the way we came out of it. And of course, it interacts with not just these transitory measures, but also the transformation, which is permanent, right? So I don't see working from home leaving us anytime soon. Perhaps it will converge in a slightly different version than the one we have now, but we're not going to go back to the same world we had before. And the reason for that is, people were already planning for this. They were already expecting a transition towards more working from home. It's just, the pandemic kind of gave an impulse to do it all at once rather than over a decade. What I would say that is perhaps self-inflicted is the way we dealt with it was through a massive fiscal expansion. And that typically leads to inflation, right? Not necessarily. It didn't happen during the great financial crisis. And that's always a good benchmark to have in mind. But, the reality was also different. The type of crisis we had was different. The amount of debt being bought by, foreigners was also different. And that helped kind of alleviate inflationary pressures. Whereas this time around, it's kind of more of a textbook example of, the government, sending, money to people, them spending it. So, more money buying the same number of goods, that drives the price up. So if you don't have to be an economist to understand that, I think. So in that sense, part of the response also created the inflation, and we'll see how this unravels over time.
Yeah. Well, Fernando, I need to take a very quick break. When we come back, we'll talk about the risks of future inflation and what consumers may be thinking about in dealing with this. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking this morning to Francisco Martin of the Federal Reserve Bank of St. Louis. Francisco, thanks so much for staying with us this morning.
Sure. It's my pleasure.
Oh, absolutely. This is great. And I love when someone can speak. You know, we hear so much jargon in the financial services world, of which I'm a part of. And it's nice to be able to hear someone speak it in a plain language and break it down for us. So let's talk about the future of inflation. This was also a blog post that you wrote back in, I think, early October. When you look out, and you mentioned, you know, we've got to find some equilibrium. I'm going to use an economist term. I'm not sure exactly if I'm using it in the correct way, but that's for you to correct me if I'm wrong. But we're going to find some point where things get back to some level of normalcy as it relates to prices. What can we expect in the near term going into, let's say, 2022, early 2022 and into maybe 2023?
Yeah, that's a big question out there, right? So we hear everything about transitory inflation, and it's not obvious what that means, right? I mean, transitory means, not permanent, but doesn't tell you for how long. So let me make just a quick clarification on what we mean by inflation, right? So inflation is a change in prices, right? So if you pay for something $10, And then you pay 12, the price went up by 20%, and we call that inflation. Now, what we usually call inflation is something that is ongoing, right? So every time you renegotiate your wage every year, you get like a 2% raise. That's not a raise, right? That's keeping up with inflation. Why? Because you expect prices in general to grow, let's say, at this 2% rate, so you're just keeping up with that. But sometimes you get the promotion and your wage goes by 20%, say, or 10%. So that's exactly what's happening now, which is kind of a combination of those two factors. There's a lot of relative price changes, things getting more expensive because of surges in demand, etc., as we were discussing before, and those have kind of a one-time nature. So some things are they became more expensive, and that's it, right? So now you pay more for a particular good relative to what you used to pay. What we worry about in the very long run is at what rate will all these prices grow. So that's what the Fed calls kind of the long-term expectations, right? And as long as those don't get too out of whack to what the Fed wants, it's not an issue. So whenever they tell you, well, it's transitory, and we are not concerned because long run expectations are still anchored, which means the market expects, say, 2% in the next 5 years, that's what they mean. That means that, well, whatever happens today, at least everybody believes that the government and the Fed will do whatever it takes so that inflation in the long run behaves in the way we announce it. Now, the question is what happens in between now and whatever you call the long run, let's say, 5 years from now. And then you have to start worrying about, well, there are all these prices increasing and, other prices maybe have not caught up yet. So you can expect because, okay, the TV now is more expensive, but how many TVs do you buy? But if you go to the input of that TV, a chip, well, if that chip is more expensive, there's other goods that, depend on chip value. There is the cash register that has also a chip inside. And if the cash register is more expensive, then, the cost for, let's say the grocery store or the restaurant is going to become more expensive. So that means their prices will probably go up. So that process unravels over a certain period of time, and it's not particularly well coordinated, which means you see one month some price increase, some other month some other price increase, and they all kind of catch up. So what I see right now is we have the big acceleration of prices, in part, like we discussed, driven by perhaps supply problems, but I would say in a large part driven by the fiscal expansion. And then you ask, okay, so what's going to happen next year? Well, a lot of that depends on what we're going to do on the fiscal front. So are we going to pass new legislation that is going to involve sending even more checks to people that will go and be spent? So that, that reality is going to, at the end of the day, tell us whether we're going to see even more inflation or not. So if we were to stop right now and stop with this fiscal expansion, it would naturally, expect prices to go back to, on average, increase at 2% over time, because we haven't done anything to break down that credibility. But, if we continue, doing big packages every year, especially ones involving transfers, then you can see, okay, so we have current inflation based on the past fiscal expansion, but if you continue doing that, then you can continue, experiencing similar impacts. So like I said, a lot will depend on which programs pass. We just had one passing in the last few days, which is mostly infrastructure, but involves many transfers, but there's another one coming, and we'll see whether that one passes or not. And I think that will determine a lot whether, prices will continue increasing or not, especially because now it seems like, there's always a taboo in the sense of who's going to be the first one increasing prices, right? And sometimes, maybe you see a lot of demand, but you don't want to be the only one raising prices because you fear your individual demand may go down, they may go to your competitor. But when you see your competitor raising prices, you say, well, I will do it too. So that taboo breaks down and we all get used to increasing prices. So whenever we see surges in demand, we're going to see a transmission towards prices much more quicker than in the past.
Last question, Fernando. Is there anything that the consumer can do day to day to abate or mitigate inflation, short of not buying something or changing the type of brand that, or maybe not going out to dinner, but can can an individual have an impact on, I guess they can have an impact on their own, the effects of inflation on themselves, right? Because they can choose not to buy, but they have very little control in totality of this. This is really not again, I don't want to put words in your mouth, but this isn't something that a consumer per se can control.
No, that's entirely correct. So another word for inflation is cost of living, right? Some people call it that. Why? Because it's how much it costs to you to go on with your life. So from an individual perspective, there's not much you can do, right? So there's several million of us in this country, several billions of us in the world. So individually, there's not much you can do for what happens to inflation in the aggregate. But for sure, you are in charge of your own, consumption basket. And you would expect that as certain things become more expensive relative to others, especially if it persists over time, that your consumption patterns will be different, right? So we you could see that in the 70s as energy prices surge, it's not like you continue behaving and driving the same way you used to. If you get a surge one day, yeah, then you start seeing, big lines of people trying to get gas because it's one time, right? But if you have persistently higher energy prices, then you start thinking about, well, do I need my car today to go and do what I was planning? Maybe I can walk to the grocery store. So that doesn't mean that this makes your life better, but for sure it tells you that, your consumption behavior responds to what's happening to prices. And that puts, when it's more widespread, it also puts a brake on, that demand that is fueling the price increase. So for sure, as consumers start reacting, as we stop buying chips, say, computer chips, I mean, that puts you can buy the other ones. That puts a brake on the overall demand, and that will put a brake on inflation. And as we know, wages catch up, then things kind of return to some sort of normal. So not at individual level, but all us collectively, for sure. And you should expect certain changes in consumption behavior for sure.
Yeah, well, it's certainly going to be interesting to watch. Look, Fernando, we certainly appreciate you joining us on the program and breaking it down in a clear and concise manner. Thanks for joining us, and we look forward to having you back on the program again very soon.
You're welcome, and I appreciate the opportunity to talk about inflation and other topics.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement, markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. Don't forget, we're back again tomorrow. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.